Hello and welcome to The Upside. I'm your host, Jordan Chevalier. Today, we're joined by Ilan Kolet, Institutional Portfolio Manager and member of Fidelity's Global Asset Allocation, or GAA team. Ilan helps manage billions of dollars on behalf of Canadians. He's here today to discuss the latest Bank of Canada rate decision, what it means for Canadians, and what could be next. We'll also dive into the latest tariff news and unpack the U.S. tax bill. Ilan, thanks for joining us today.
Yeah, thanks, Jordan. Great to see you.
So the Bank of Canada, they held its policy rate. What are your sort of initial thoughts? Were you expecting it here? What are we thinking?
Yeah, so it's really interesting, right? Things are getting really interesting. Just as a reminder, myself, David Tulk, David Wolf, sort of 20 plus years combined experience at the Bank of Canada. And so we follow the developments closely and sort of micro-analyze every single statement that comes through. What I would say here with the Bank of Canada is it's actually not that interesting at the moment, right?
Okay.
I know that's probably not the way we wanted to lead off the discussion, but the Bank of Canada is in a wait-and-see, data-dependent, ready-to-react sort of mode, right? That line, ready to react, which we've heard several times at either press conferences, is the right approach to take. And the reason it's the right approach to take is because of the incredible level of uncertainty around tariffs and trade policy. The Bank of Canada doesn't want to, react in such a way to lower rates ahead of time in the event that these tariffs get negotiated away, and now they're overly stimulative with inflation not really where they want it, and then they have to kind of reverse course, right? So this ready to react, wait and see, data dependent approach is the right move right now, and that's exactly what we got, right? That's exactly what we got. But what I would say is the likelihood, and I know we're going to talk about tariffs, the likelihood that tariffs actually do show up in terms of a slowing is probably already here, right? Households holding more precautionary savings, companies kicking hiring and CapEx plans, and this will hit the Canadian economy and will likely result in rate cuts at some point this year. But for right now, what we saw, what we saw recently, what we saw yesterday was a wait and see, data-dependent approach. Focusing really on that near-term information. The last point I'd mention there is, central banks have one job: low and stable inflation, right? Generally, right. Inflation is not where it needs to be in Canada. We're getting there. We're much better than we were a few years ago, but we're not where we need to be. And with inflation sort of stubbornly elevated, you don't want to, preemptively cut rates when you don't have that inflation right at target, and we're not at target yet.
So there is sort of a sweet spot that the Bank of Canada is going to say, this is our right, this is the rate we want it to be at.
Exactly, and I mean, that's changing all the time. It's unmeasurable, the so-called R* neutral rate.
Okay.
I know we don't want to get too nerdy, but that neutral rate of interest is very, very hard to assess. The bank would love to be done, right? If tariffs went away, right? If we could snap our fingers and tariffs went completely away and all the uncertainty went away, the bank, and even the Fed for that matter, would love to be done. But that's not the world we live in, right? So they have to sort of guard against two different scenarios. The first scenario, and they laid this out beautifully in their April Monetary Policy Report, which is very accessible, I would say. That section is a really interesting read.
Because when you hear, April Monetary Report, you think, oh my goodness.
Yeah, it's not. They've done a really good job. The bank has done a really great job of making those monetary policy reports accessible and readable to Canadians, right? The people that they serve. And so scenario one is tariffs get negotiated away. That's a slowing in growth. Scenario two is much scarier and something that would result in a totally different path for policy. But right now, the right stance for the bank is a wait and see approach, data dependent and ready to react, right? Which is that ready to react is the line that I think, they've all said this is going to be our line.
Sure, the key message.
The key message, exactly.
And has that approach and has the pause affected the Canadian dollar at all? What are we seeing there maybe over the last, month or month and a half?
Yeah, so the Canadian dollar has been really, again, a really interesting move in the Canadian dollar. Canadian dollar has appreciated measurably, right? So we started the year in that 69-cent range. We're sitting around 73 cents as of yesterday. That's a measurable appreciation, right? Pretty significant appreciation, I'd say. But the reason for that appreciation is less to do with sort of anything remarkable or incredible happening in Canada, and more that end of U.S. exceptionalism, right? And so again, it's not impossible for the Canadian dollar to depreciate when the US dollar is depreciating. But in general, if the US dollar is depreciating, the Canadian dollar is appreciating, right? And what we've seen is all of last year, I spent every presentation and every road show and every Fidelity Connects was about the remarkable level of US exceptionalism. And it was justified, right? So the exceptional level for the US dollar and valuations. And now that exceptionalism has come under threat, right? And this is something we talked about in our Q2 paper, Elbows Up. And the US dollar is depreciating, right? And it's depreciating because the underpinnings of US exceptionalism have come under attack. And in the event of a broad US dollar depreciation, the Canadian dollar is going to appreciate, right? And that's what we've observed so far. It didn't move that much, I would say, with the Bank of Canada decision yesterday. And we don't look at day-to-day movements. That's not how we kind of manage the funds. Right. But with the general appreciation, I would say, of the Canadian dollar, depreciation of the US dollar, we have essentially removed our exposure to that US dollar weakening, right, in the funds, which is another layer that we can help underlying investors sort of preserve capital and do well in the funds that we manage for them.
Yeah, that's great. Very well said. I know a lot of questions are coming in. I'm sure you're getting them as well. U.S. trade policy, right? We've discussed it a little bit. The latest item being the sort of doubling of the tariffs now to 50% from the U.S. coming into Canadian aluminum and steel. What do we have there? Is there any sort of things that investors should be watching or looking for? Sort of a quick review.
Yeah, so tariffs, this is an interesting one to talk about. By the time we're done this discussion, it might be different, right? And so
in 20 minutes,
exactly. Please back away from the keyboard, right? It's sort of the message. But jokes aside, tariffs at a high level, tariffs could be exceptionally damaging for Canada. So, let's lay out a few numbers just to sort of set the stage. When we're interpreting and analyzing the effect of tariffs, there's three assumptions we need to make. How big is the tariff, right? Is it 25? Is it 50? Is there a carve out for USMCA? Is it 107 like it was on China for a few days? What's the number? Two, what's the list? Right? Is it everything? Is there a carve out? Is it one or two items? Is it steel at a higher rate? And the third assumption that we need to make is how long do these last? Right? Is this a negotiating tool? Is this a permanent new level for everybody?
Right.
And we've talked about this before, but the most honest answer to those three questions is I don't know, I don't know, and I don't know. Right? But the way to put tariffs into perspective is the following, right? 30% of Canadian GDP is exports. Okay. To put that in perspective, 10% is housing. So trade, exports have 3 times the impact, right, than new construction in terms of Canadian growth. That's enormous. 80% of those exports go to one place, you guessed it, the United States. So 20%-ish of Canadian growth just by itself are exports to the US. That is exceptionally high. Right? And so it's no surprise that we're particularly vulnerable. And I think there's sort of 2 paths ahead of us, right? And again, I think the Bank of Canada did a good job of explaining this. The first is tariffs get negotiated away. This is a slowing in growth as households, Canadian households, folks listening to this, kind of hold more funds, precautionary funds, right? Keep it out of an investment account because they want to hold more precautionary funds. And 2, firms kick the can on hiring and capital spending, right? Because businesses don't like uncertainty, and that's uncertainty. And then they get negotiated away, and then we kind of come back to a more normal growth environment in Canada. The second is 25% tariffs permanently on everything forever. That's a very, very negative scenario, right? That's a serious recession. That's a depreciation of the Canadian dollar and an upward shock to inflation, right? It's a very, very bad scenario. But I don't actually think, and most of us don't think we're going to end with that exceptionally negative scenario. We'll probably end up with something that resembles something closer to scenario 1. Okay. And, I was in DC a couple of weeks ago and, with an association that I'm a part of, and we had meetings at the Treasury Department with senior officials. And, they're closed door meetings and we can't really discuss who said what, but the general takeaway from those discussions is things are going to be choppy and messy until there is an agreement and and signatures are signed and hands are shaken.
Mm-hmm.
And then we are on the other side of that with something that looks like a more permanent solution to this trade uncertainty, right? And the context of our funds, what that means though is we have to be diversified across regions, right? And we have to build in defensiveness into the portfolios to help investors still achieve their goals, right?
So there is almost a wait and see approach,
Exactly.
right? Especially when we're looking at tariffs, they seem to double. They could just as soon, be halved or completely eliminated.
Exactly, right? And so, it was very, very jarring when tariffs, when borders sort of got thicker.
Sure.
We sort of saw that at the start of this year. But given the volatility in the announcements and in the policymaking, I think what that really signals is this. I mean, the U.S. used to be a stable and predictable economy,
right.
Stable policymaking, and in the event of this sort of volatility, policy volatility, if you will, it means we have to position the funds in such a way to be a bit more defensive, so lean away slightly from the U.S. Right, still plenty of U.S. in our funds,
Absolutely,
but lean slightly away, and right now sort of lean into Europe. Right, Europe is showing signs of galvanization.
Okay.
Which again, we haven't seen in decades.
Yeah, there really was no, there was a little bit of,
Right.
sort of relationship there, but certainly
Right.
not to this level. Can you speak a little bit more about
Sure.
that? Sort of maybe where in Europe or things that maybe signals that investors could be looking for?
Yeah. So I mean, in the past when I was on the road, people would ask, well, what are your views on Europe? And I would sort of joke, I love going to Europe, but Europe's a terrible place to invest. Right. So wonderful place to visit,
Right.
terrible place to invest.
Right.
I said jokingly,
Sure.
Because for any investor or advisor listening, any dollar invested in Europe over the last 15 years instead of the US would have been poorer performance. So last year I was getting questions like, why would I own anything but the US?
Right. Mag
Wow.
7.
Exactly.
Right. Slap
Exactly.
it on and that's it. Yeah.
And now, I mean, we're seeing the benefits of diversification.
Sure.
Right? So right now, one of the most important overweights in the funds that we manage is to the European asset classes, European stocks. And that's been incredibly helpful. We know what's happened year to date. And, in that paper that we wrote in Q2, we put a really cool chart in that paper. I mean, I love all my charts equally.
Sure. But
we
maybe
put
a little favoritism.
a little bit. We put a neat chart in there showing German defense spending as a share of GDP, right? Which was 1% for 20 years, right? And, we heard about that through Europe not meeting its NATO targets and stuff like that. But something happened in the start of this year that has led to a lot of European nations saying, well, we have to loosen up the fiscal constraint.
Right.
And German defense spending has hockey sticked higher, right? And that's shown up in the markets, in individual names. And we're leaning into that as asset allocators as well to take advantage of that. Just to not, I mean, we have to lean in and out of asset classes, styles, sectors, geographies, and currencies. That's how we add that additional layer of return.
Okay, great. Staying with U.S. policy a little bit, another sort of high news item or a popular news item is the U.S. tax bill. Can you break that down a little bit for maybe people who haven't read, past the headline and maybe want to know a little bit more?
Yeah, I mean, and this changes a lot, right?
Okay.
There's a lot going on, but really the bill is sort of projected to support cyclical growth, potentially offsetting the drag from tariffs, estimated 1% of GDP of stimulus in 2026. But what I'd say here is there are concerns really around the fiscal sort of irresponsibility, rising bond yields, and claims that growth and tariffs will offset the debt increase, right? That's seen sort of as optimistic in our view, especially given delayed spending cuts and assumed future tax hikes, right? So I would say for investors, though, what this bill means is it may support risk assets in the near term through stronger corporate earnings and sort of reduced recession risk.
Okay.
But it also raises medium-term concerns around treasury supply, long-term fiscal sustainability. But what I would say is, again, for us at a high level around the U.S., it's this underpinnings of exceptionalism sort of coming under attack. And for us, it means the right asset allocation decision for us is to sort of lean away from the U.S., right?
Okay.
Still plenty of U.S. in these funds, just leaning away and looking elsewhere for sort of opportunities from an asset allocation perspective.
And staying with the bill a little bit longer, are there signals that you're looking for? Things that you're saying, okay, once this happens, right, then we can shift or allocate in a certain direction.
So, I mean, The best answer to that is this is how we work with our researchers. Right?
Right.
So we have a fantastic dedicated team of asset allocation researchers.
Okay.
The team I used to sit on when I was in Boston, right,
Yeah.
from 2014 to the kind of middle of 21.
Mm-hmm.
And we have folks that have deep experience thinking about policy, fiscal, both monetary policy and fiscal policy. And we really rely on these researchers to give us sort of the nuanced view around U.S. fiscal policy and what it might mean for investable asset classes, right? And so that's a key input into our research process, and we'll continue to do that, and that's how we'll sort of navigate things going forward.
Just maintaining focus on that research,
Exactly.
on a day-to-day.
It's the answer to every single question you could ask.
That's
is
right.
Research.
What are the analysts thinking?
Research. Right.
Yeah,
Exactly.
amazing. Great. So, Ilan, this has been a fantastic discussion. I wanted to, kind of pick your brain right before we end off here. Any kind of final thoughts, things that you want investors as we move through the news cycle, tariffs, tax bills?
Yeah, sure. Yeah, I mean, I think it's natural to, given the news flow and given the volume of news that we're all
Sure.
consuming, it's natural at times to think, to get that negative reinforcement, right? Through news, through media, through the socials. But what I would say is this year is one of those years where the benefits of a well-diversified portfolio and conversations with your advisor are really, really critical, right? So even though we know that year to date, the news out of the U.S. financial markets in particular have been kind of scary.
Mm-hmm.
One thing I've been saying, and I said this, yesterday in Vancouver, last week in Halifax and Ottawa, and the week before, I've been on the road a lot, really over the last few months, is the news is not your statement, right? So again, maybe turn off the news and kind of call your advisor and have a thoughtful discussion with them about your objectives and how those Fidelity funds have done.
Right.
It's not nearly as scary as the news you're sort of being pummeled with, right? And so going forward, we'll continue to, as our CIO said, add value 1 point at a time to the mountain every single day, right? We'll follow that research process. And that's how we sort of achieve those long-term objectives for our investors.
That's fantastic, Ilan. I think that's a great place to leave it. Thank you again for coming and speaking to everyone here today.
Super. Thanks, Jordan.
Thanks for watching The Upside. For more investor content, visit Fidelity Canada's LinkedIn page and YouTube channel. And remember, working with a financial advisor is the best investment you can make on your financial journey. Thanks for watching. I'm Jordan Chevalier. I'll see you next time on The Upside.